For those of you that don't know me, my name is Deborah Young and I'm the CEO of the RegTech Association. And I'd like to start our meeting today by acknowledging the traditional owners of the land on which we are meeting and pay my respects to elders past, present and emerging, and offer a very warm welcome to all Aboriginal and Torres Strait Islander friends that might be here with us today. As I was saying, we at the outset were very ambitious for this event and decided to run it as a hybrid. So that actually means that I not only have an audience online, I actually have an audience in the room as well. And it's like a finely oiled machine. So please bear with us. We're going to try and make this as seamless as possible for you all, but there might be some interruptions as people are flowing into the room. So please do bear with us. One of the things that I wanted to talk about, I don't think that slide's coming up.
It should work now, but keep.
Actually, I will just quickly go through some housekeeping. Oh, this is back. Sorry, everyone. We go through some housekeeping. So for the people online, if you would like to put your questions in the chat and I will moderate them from there. What would also, you could direct that question, whether it's a general question answering so that we know who is saying what. We will be recording today and a copy of the recording will be sent out to you. And so for now, if we could just have anybody online, cameras and mics off, thank you very much. So one of the things I wanted to start with, a very surprising stat came out a couple of days ago. And it was put out by an organisation called Juniper Research. And what they've said is that by 2026, the global RegTech spend will be $204 billion US, and that is in financial services alone. And the UK and the US market will make up 50% of that spend. So this tells us that we are looking at ways to help our members get the capital they need to maximise their potential in these two markets. And in fact, we're working actively on export programs to both of those right now as we speak. And many of you will have heard me say in the past that Australian RegTech is the third largest group of product producers of RegTech in the world. And so if we say that that is the opportunity, Australia stands a really fantastic chance of really leading and being able to make some headway. Our recent survey that we did of our members just a couple of weeks ago revealed 37% of them have raised capital in the last 12 months, and nearly 38% are either raising at the moment or are intending to raise Series A, and about 23% in Series B and 23% at the seed level. Financial services remain a key segment for us, but we are seeing growing amounts of interest beyond the big four banks. Sorry about that, Gareth. Beyond the big four banks, down to the second tier financial services firms is a very attractive segment. And then the segment that's actually, I think, will become equal to financial services is that of government. And we've certainly seen during the pandemic a real uptick in government appetite around purchasing RegTech. So that's not government from a policy perspective, but actually as a buyer of RegTech solutions. So I think that government and financial services is an enormous opportunity for our members right now. One of our key strategic pillars is around attracting and unlocking investment opportunity and helping our members to engage. And by developing this program, we just hope to fast track that whole thing. And I think it's really important, especially for RegTechs in the room that haven't had to raise professional capital before, that we've put together a group of people who can tell them in real terms about what it is that you look for, what VC and PE is and what it isn't. And so that will be all helpful for them in the next part of their journey. And I'm really pleased to see that there's so many old faces, not old, but that old. Well-known faces in the room are people that I've known for a very long period of time, and I'm also really grateful to have the Australian Investment Council here as well. I used to work there before it was called the Australian Investment Council, and you'll be in very good hands as we kick off with their 101. We've invited AIC to come and give us a bit of an overview of PNVC and get us all on the same page. And perhaps we can also probe them around some of the things that have been in the media just recently around valuations and expectations of tech firms around valuations, which was raised in our briefing meeting.
Thank you, Deb, and to the RegTech Association for inviting me to speak today. I'm Robyn Tolhurst. I'm the Public Affairs Manager at the Australian Investment Council. We represent the private capital industry in Australia, being the private equity, venture capital, and private credit funds, as well as our members to those particular parts of the industry, sovereign wealth funds, family offices. Altogether, our members have $42 billion in assets under management in Australia, and the industry is continuing to mature. So I just wanted to start off today just talking about the venture capital landscape in particular, because I know that there are people in the room and online who have either had experience in venture capital or relatively new to the industry. I think the most important thing is that like venture capital investment, if we get down to real basics, it's really about providing investment for companies to enable them to get to a stage where they can translate research or where they can commercialize an idea and to get them into that cash flow situation. And for anyone in the room who's been through a venture capital process, you realize that, you know, there are many learnings along the way and it's not always easygoing. But essentially, it's about helping companies. Venture capital industry supports companies to invest into them, to help them grow, to provide expertise, to expand their concepts or their particular markets, and to help them become profitable. Of course, Australia, we've got a number of unicorns. We know all their names, so the industry is maturing, but we're not yet at the stage where we're on the same level as the Americas and Israel's and UK. So essentially, the system, we have a limited partner who provides money into the general partners, and they're the ones who manage the investments. They select the investments, they look at the portfolio companies, and portfolio companies are generally companies. If you look at a VC fund or any funds, they will have a particular area of expertise. So whether it's technology, whether it's med tech or whether it's ag tech, they usually have a very set focus on what they invest in. Of course, there are the exceptions. There's 3 or 4 much larger funds in Australia. You may have heard of Airtree, you've heard of Square Peg, Main Sequence, and Blackbird. They have a much wider remit, but still they're very focused on what they're investing in. And within the industry, there's the advisors and consultants are a really important part of that process, because they're the people who really understand the industry. They're helping put together funds. They're helping the funds actually liaise with government to put together the right sort of formats to meet within the Australian setting, which is a little bit unusual compared to other jurisdictions like Singapore or the UK or US. So essentially, this is just a little diagram to show you like how the sort of ecosystem works together. So you've got the angel investors, you've got yesterday or earlier this week, I was at our venture capital forum, which we hold every year, and I had the pleasure of interviewing a terrific managing or CEO from a company called Zero Latency, and they had started off crowdfunding. It was right during the sort of mid-2014s, 2015s, when it was kind of seen as a bit dodgy, and there was a bit of, you know, a few people using crowdfunding for the wrong reasons, and he was like raising right during that period. But anyway, he managed to get across the board to get this sort of immersive gaming company up and running. And then he had his own brand. So I think this is really important for anyone out there, that if you're running a venture capital startup, or you have a company, is your personal brand and kind of getting it out there, having a clear picture about what it is that you do, and building your profile, because often the investors will come to you. It's harder to go to an investor. So the investor needs to know what your value proposition is and what it is that you're offering to the market. And Zero Latency managed to get himself into the Financial Review. It's a really hard thing to do when you're not a well-known company. And then he got noticed by a VC company, and that's how the venture capital round started with Cathona Capital. And then they've grown over the last 12 years or so. And late in 2021, a PE firm helped them, came on board, because they were really at that stage of growth where they needed to find new markets. They needed to have more strategy and more involvement to help them develop the business. So it's a really great story, and I think this is an example of if you look at the ecosystem and it works well, it can work really well. So just looking at the different kinds of VC funds, I think as a startup company, it's really important to be aware of what the funds do and to do the research and to find out exactly what they focus on, because different funds, as I mentioned earlier, they have not only different focus of industry sectors, but they also focus on different sort of levels of funding. So are you looking for seed funding? Are you looking for Series A? At what stage are you at realistically? And that will sort of help go, put the business through the funnel and help you decide what you're looking for. So VC, and I think the VC investment is really important to sort of understand that it's more than just investing in a company. It's sort of helping with investor relations, helping the company with compliance issues, because there's a whole minefield out there. We know with the RegTech, there's many issues that need to be dealt with at a governmental level, both federal and state, as well as tax issues and regulation and so forth. So there's a lot of compliance that needs to be done. There's reporting, there's analysis of the company, and marketing and so forth. So in terms of what VC funds look for, and I'm sure the next speakers will be way more adept than I am in terms of providing further information on what the funds look for, but they're essentially looking for, do you have a clear indication of what you represent? Do you have a mission, a vision? What's the problem that you're trying to solve? We often hear this, but usually there's a problem, and as a startup or a business, you have a solution. Is there a market for this? Have you actually already developed your concept or product to a point where you can take it to market? Is it scalable? Is it transferable to other jurisdictions? And what's the history of the founding team? I think that's really important, because the VCs investors, they like to align with founders and to make sure that they have the same values and mission and so forth. Can't stress enough about being prepared, particularly in that sort of early stage of understanding the firm, as I mentioned before. Do they invest in your sector? What are the investment stages? What's their trend? How much do they invest generally? Another great session we had the other day was looking at one of the corporate venture capital funds in Australia, Telstra. They have the ability to write smaller check sizes, but they obviously have a very specific mandate. Whereas when you've got the very large funds that superannuation and the big funds are investing in, we know that super's getting bigger, so they're needing to write big checks for VC investment. So it's really understanding who the players are in the market and how much they generally invest in the transaction. Having a business plan, preparing your pitch. If I'm to meet you in the elevator and you can tell me in 3 seconds what your company does and wow me, then you've done your job. So I suggest looking at our website, aic.co. There's some really great sort of templates and ideas there that you can just, click through. There's sort of open access, and you can find how to prepare a pitch, how to prepare a business plan, and some really great resources there. So highly recommend you look at that. So just a quick overview. I won't take up too much time because I know that we're running out. Just looking at how Australia compares to other jurisdictions. We are quite a small fish in a very big market, but we do know that the industry is maturing. We've seen some great transactions, some great fundraising in recent years. VC in Australia does have a very large tech focus if you're looking down industry verticals. FinTech is a big sector, looking at education, healthcare and so forth. It's quite a big investment. So it did slow down in 2021. These are our latest figures. So 6 funds were closed with 492 million. You can see quite a significant drop, from that height of COVID to the next year. But we do see an increase in fundraising so far in 2022. So probably expect that will, continue throughout the year. And once we have the results early next year, we'll be able to look in hindsight and see how things went. These are just examples of some of the sizes of the funds, the biggest funds and transactions from 2018, 2020, in recent years, probably a bit later, 2021. SquarePeg, of course, Blackbird have had some very big fundraisings. So just looking at the VC investments, we had a strong performance since the GFC, massive deal value in 2021. It was double the year before in terms of value. 267 deals were completed and the average deal size was 296 million. So that concludes my part of the presentation. As you can see, it's an important part of the ecosystem. It generates jobs, it contributes to R&D. And while it's a small sector, there's still plenty of scope to grow. Thank you.
Thanks, everybody. I'm happy to introduce Patrick Verlaine from the Australian Business Growth Fund, who's going to speak to you next. And if I can just ask you, Patrick, to speak into the computer. Thank you.
My best.
Thank you.
Thank you, Deborah, for the introduction. So my name is Patrick Verlaine. I'm the co-head of investments of the Australian Business Growth Fund, which is a newly created fund. I'll take you through our mandate in a second. So it was really established in 2020, but really only got started, I guess, in 2021 with recruitment of established with $540 million of capital. A partnership between the federal government and the 6 banks you can see they're listed below. And really the fund was created gap between venture capital and later stage private equity. So that's what we call, I guess, the growth capital stage. And what we see both in Australia and all developed economies is a gap between essentially businesses that are break even to about kind of $5 to $6 million. And that gap is really a structural gap based on the funding, the fees generated by PE funds. There's a lot of money in by our private equity, but actually in that space, in that growth capital space, which is why it's taken the government, I guess, and the 6 banks to actually come together to try and provide equity solutions to that space. So the funds goes is driving economic growth and fundamentally about driving employment and supporting Australian technology and innovation. So the mandate of the fund is actually very broad. So firstly, it's important to highlight that we are industry agnostic. That means that we'll look at pretty much any industry. The only things we can't really do are and any APRA regulated businesses, and that's because that competes with our shareholders largely. But outside of those two exceptions, we can pretty much invest in most industries. So in terms of what the ideal metrics are that we look for in a business, is that it's really got to be Australian headquarters. That's a key requirement. As you can see, the mandate from a revenue perspective is very, very broad, between $2 and $100 million. I'd say our sweet spot's really between, call it 8 to 10 and probably 60. That's really where we prefer to invest, but we can go as low as 2 depending on the growth profile of the business, and up to 100. Again, we look for profitable businesses, so we don't seek to compete with venture capital. So we're not looking for startups. We're looking for businesses that are commercially proven and ideally turning a profit already. Like any equity investor, we look for unique value propositions, like defensible market positions or barriers to entry or some sort of IP, something that differentiates your business really and makes it sustainable. And clearly, as the name implies, we look for growth potential. Having said that, we don't look for the growth potential that VC typically apply. We're not looking for 100% growth a year. Look, if you can see that, obviously that's fantastic, but we're comfortable with significantly lower growth rates than that. But obviously applied to slightly more mature businesses than the VC market typically attracts. In terms of our value add, we have an active investment philosophy. That means that we will position, and that's because we hope to bring more than just money to the table. The idea, very much like most of the private equity and I guess venture capital industry, it's about bringing capital, but also experience, right? And that's about taking a board seat and helping, I guess, the business navigate the challenges of growth and really accelerate the growth profile. So that's through strategic support, and importantly, it's also about linking the business with the right talent at different levels. That could be at executive level, non-executive level, and then connecting the business with the right partners through the growth stages, right? So whether that's a vertical integration, whether that's international expansion, whatever it may be, it's helping the business connect with the right people through our talent network. So we've dedicated resources internally to develop that network and to effectively help find the right people for whatever's required in that growth journey. How we invest, I guess the key differentiators between ourselves and most of the peers within certainly the private equity sector is that we're minority only. So we'll take up to 49% stake, and by mandate we can't take any more than 50% essentially. Our check size is also relatively small compared to the rest of the industry, so it's a $5 to $15 million investment. So we cap out at $15 million up front. We can invest a total of 30, but that's in subsequent investments. So really the initial investment's a minimum of 5 and a maximum of 15, and then we can follow on with up to 30 in total. Board partnerships, so I said we'll take seek to take a seat on the board, but again, I insist always in a minority position, and we never seek to gain control of the board. We're also happy to co-invest with other investors. In fact, we've already made 2 investments as co-investments, so happy to work with other partners throughout the capital structure, whether it's other equity partners or existing shareholders, obviously. I guess it's just important what we don't do. We don't do startups. We don't do controlling equity stakes. We don't do chain control buyouts. We don't do distressed investments. Just a quick case study, I guess, to highlight some business we've been looking at. This business they were invested in only a couple of months ago. It's an enterprise architecture business. I actually didn't know what that was until this landed on our desk. It's actually software that helps major corporates undergo digital transformations, and really that's IT infrastructure transformations. As you can imagine, large corporates have a lot of disparate systems, and it's very hard to identify what the consequences are of making change to one system and how that flows through the rest of the system. So enterprise architecture helps you map all that out, helps you map out the flow of data throughout the business. And identify what happens if you pull one lever and what the knock-on effects of that are. So this business that was a leader in the Gartner Magic Quadrant, for those of you, I guess, magazine in terms of technology businesses. So it's been recognized internationally, but still a relatively small Australian business, huge growth potential for additional capital for support. Mostly around people, so a lot of developers, they need development support, DevOps, business development, overseas expansion, and also some CapEx internally. So we invested $11 million in that business, and really, early days for us, but I guess it highlights what we can bring to the table. Again, in a minority position, allowing that board and that founder to retain control, and really, I guess, dictate itself. Up. So here are my contact details, but I think the easiest way is if you just head to our website, there's plenty of options on how to contact us directly. I think that wraps.
Thanks very much, Patrick. What we'll do is we'll, because I can't multitask here at the moment and can't see the questions, I will direct those questions at the conclusion of all the presentations. So next up, my old friend, my aged friend, my old friend, Symon Vegter from Advent.
I'll take that as a compliment. Thanks, Deborah. Yes, and we are also the private equity partner for Zero Latency, to link up the prior conversation as well. So thank you, everyone. My name's Symon Vegter. I'm a partner with Advent Partners. I've been with Advent for 15 years and been doing helping businesses for over 20 years in either advisory or private equity capacity. So a little bit about Advent. We're Melbourne-based, one of the oldest firms in Australia, started in 1984. There's a new generation of partners now in charge of the business, including myself. There's 5 of us that cover Australia and New Zealand. We're very much focused on building market leaders or helping them grow into not only domestic but international markets. I think at the moment, close to 70% of our portfolio is international, either focused on North America, Europe, or Asia. I'll talk to our partnership focus shortly in terms of our approach and style. It's about finding fantastic founders, fantastic owners of businesses, who have a big drive, big ambition, and we're helping them along on the journey as true partners. As I said, we're the owners of our firm. We've got money invested in our fund, and we're very aligned with succeeding alongside our partners. What's really important to us, and increasingly so, is responsible investing. I head responsible investing at Advent, which relates to ESG. We're in the process of ensuring all our portfolio companies are measuring their carbon at the moment, and we were also really focused on ensuring giving back to community and society as well. We do that via Vegter. And we're doing a treadmill challenge next week, 24 hours for that wonderful charity. I talked a little bit earlier about partnership, and it's a really important part of our style and philosophy. There's lots of good and bad stories about.
We are pushing.
Excuse me, I'm sorry. Just on mute, please. A really important attribute, the private equity has good and some bad stories, and so we really focus on building a very strong relationship as that first investor with the founder business, and you really do that through building trust and building a relationship. So a lot of the investments we make, we typically have either a 2-year, 3-year, and more recently a 4-year conversation when they're ultimately ready for our approach and style. Talked about partnership. We're very active. We're a very supportive partner. We don't get involved in day-to-day operations of the business. We're very clear about that. We're active board members, and we bring insights from our experience across very similar businesses to help assist with scaling and growing businesses. And the particular areas we focus on, as I've talked about, a strategy, really helping with go-to-market, so around sales and marketing, talent acquisition, governance improvements, and then finally capital markets, whether that be M&A, sourcing debt, or ultimately exit. And one of our things we like, our style is we're very pragmatic and we like getting things done. In terms of our investment parameters, we are later stage in so a next step along from what Patrick was talking about. So these businesses are scaling and growing. Their markets are identified, there's product market fit, they've got fantastic reference customers, the product is really well developed, and we're just helping with the next stage of growth, which is about a lot of investment in sales and marketing. We focused, as I said, around those particular positions. And in terms of some examples, I've just talked about Zero Latency, which we invested in last year, which actually is not on this page for some reason. But we invest in vertical SaaS opportunities, so typically B2B, which is highly relevant to this audience. So the examples there are Compass and EdTech, FlintFox, which is in Auckland, which is ERP tech, MedTech, which is obvious, Martech, and then more recently ICT, which is a prop tech investment, which has a hardware and software element. We also invest in other sectors, but for today's audience, that's who we focus on. Quick sort of highlight on what we're talking to our portfolio about. So I thought I'd just give you a quick run around on that, and I won't go through this entire page. I guess we're at a really important sort of inflection point in terms of where we're seeing investing. Obviously, a lot of froth has come out of the tech, and late last year that was over exuberance. And really, we're at this point now where there's possibly 1, 2, or 3 possible scenarios in terms of where we go. There could be a 2018 type of bounce back, and we don't have to worry about too much in terms of the markets. It could be a longer grind position for a lot of businesses in terms of just less demand for their products and services, or we are in fact heading to a fairly recessionary. We look at that from a scenario and probability perspective and think, well, the stance should be prudence at this point in time for a lot of businesses, and we're saying this to our tech businesses in our portfolio. So I thought I'd share some of this. So it's a focus on trying to maintain and grow profitability and trying to get to cash as quickly as possible. Now that for some businesses is short term, others medium term. So if it's medium term, it's about ensuring you've got funding and a runway to ensure you get to that path of profitability. And then in the meantime, preserving that capital. So if that runway is longer or it takes. So thinking about pulling back on certain investments in people, product, and growth. But ultimately, we also like to say is that there's lots of great headlines and horror stories out there at the moment, and just showing some of the charts that are quite confronting. But bearing in mind that these are off peak numbers where the correction has occurred. So the silver lining in all this is there's been fantastic businesses created during these particular environments. We are big believers in tech. Tech is a long-term trend. The disruption that tech is driving throughout the economy will continue. Capital markets will do what they do. Tech businesses will continue to grow. That's a bit about me, some contact details, and I'll hand it. Thank you.
Thanks very much, Symon. And once again, if we can just hold the questions until the end, awesome. So now I'm going to discover who's next. It's MA Growth. Welcome to Alex. Thanks very much, Alex.
Thanks very much for having me. I'll start by saying we're probably slightly at the earliest stage compared to Patrick and Symon, so it feels like we've got a good mix of in private equity. So who are MA Growth Ventures? We're lesser known in the environment, I guess. So we sit within a business called MA Financial. MA Financial is a diversified financial services firm, so probably better known in the Australian market. We used to be called Moelis & Company, which is a advisory firm, so doing M&A and capital raisings, helping listed businesses raise money or merge. That in Australia has slowly turned into far more of an asset management business. So the total MA business manages a bit over $7 billion of assets. Now that's mainly in traditional asset classes like real estate, credit. I sit within what's a $200 million portfolio across 3 funds. We have made, so we've been around since roughly 2016. I actually joined Moelis, it was called at that stage, but I was on the advisory side. I've moved across to this fund more recently. So we've made about 25 investments, 6 exits across those, and have done reasonably well across those exits per our investors. So it's a bit of a mix of high net worth individuals, our investment team, other staff across the MA platform, the MA bank, and other people. And we have a fair bit of dry powder to deploy today, and I'll take you through our investment mandate. So within MA Growth Ventures, we're pretty sector agnostic. I would say that most of those 25 investments we've made have been in technology, but not exclusively. We have, if we're investing in technology, we have a preference for global scalability. In terms of stage, we'd like to see a bit of traction. So usually we say roughly at least revenue of $5 million. It's not within our mandate. Businesses, we can go invest in companies pre-profit, as long as we can understand what the pathway to getting profitable is. Now, our time horizon in terms of investment, we like to say roughly 3 to 5 years, but again, we're pretty flexible with that, and we're pretty flexible with what the exit pathway is. We've had companies that we've invested in IPO. We've had others that have gone down a trade sale to private equity or a trade sale to a trade buyer. So we kind of help support the business, and whatever we think maximises value for the company, we're happy to take it in that direction. In terms of structure, we can invest in pretty much anything. So ordinary shares, preference equity, convertible notes. More recently, more kind of growth credit instruments. So again, pretty flexible. Our governance approach, I would say, we're probably, again, flexible. We're probably a little bit more, we can be more hands-off compared to a traditional PE firm. So we don't actually require a board seat. If there's a business that already has good governance in place, has enough sponsors that are supporting the board, and the management team doesn't think that they need someone else to sit on the board, we don't necessarily demand a board seat, particularly if we're just making a $5 million investment in a later stage business. And our check sizes, we say roughly $5 to $15 million. We can do follow-ons on top of that, so up to $30 million over time. We can do less than that. So, for example, you know, we like meeting companies even before they're making $5 million of revenue, and we have on occasion invested less than $5 million in a company that's slightly earlier than what our mandate would usually aim for. We saw a chart a little bit like this before, but hopefully this puts into context where we sit. So I would say we're definitely not an angel or seed investor, and we're not really even an early stage venture capital investor. We're more in the kind of third blue box, what we call growth investing. So we like to find a product that's been proven, it's got product market fit, it's making revenue, and really our money is coming in to help them do more of what they're already doing. So be that win new customers, enter into new markets. So we like to think of ourselves as extrapolators. So on the left-hand side, investors that kind of like a concept and are willing to take it from zero to something. We like to understand what the unit economics look like, and our capital can help that company do more of the same. So what sort of investments do we like? This is just an example of the companies we've invested in. I think broadly, we think about them in 3 buckets. So we've invested in some companies that have scalable products, like largely across enterprise SaaS businesses, to be honest. And so they're kind of the top 2 buckets. Some businesses that sit outside of that more traditional, I call it VC enterprise SaaS style. But in those cases, we kind of like the unit economics, could understand the business, and our capital was, as I said, really helping extrapolate to do more of what they're already doing, and that we were kind of aligned with.
Alex, I'm happy to say there's a RegTech firm on there that's a member of ours.
Fantastic.
There you go.
There you go. Is that to me?
Vault.
Vault. Excellent. And I suppose we could probably touch on a couple. So Vault, but then we've got Serata, which is virtual data rooms that has a kind of RegTech lens to it, and also Demist, which is a that takes data from big banks, big insurance companies, and then kind of sells it up in a package to those. So we've got some sort of overlap in the things we've looked at. I won't touch on it anymore, but happy to in sort of question time. And that's it.
Thank you very much to Alex. Now I'm going to invite Hong back because we're going to bring Cathy Lyall online from Seed Space Venture Capital. Just one moment.
Yep, Cathy, if you could just turn on your camera and mic and just let us know when you're online.
I'm online, I'm turned on.
Yep, feel free to start when you're ready.
All right, brilliant. Thanks very much, everybody. So I'm one of the partners at Seed Space Venture Capital. We back lots of the leading innovators at a very, very early stage. If I could get you to move the PowerPoint on, Hong. We have 2 funds here operating in Australia, and we're both Australian and Swiss based. One of our managing partners in Geneva. We focus, per Alex's last slide you saw there, we're very much in those first 2 buckets. So we are pre-seed. We're very comfortable with pure startups there, and we also go through to early what he was classifying there as early stage VC. So our check sizes when we come in, and that that first raise after bootstrapping as a VC tend to be around between the 100 to 200 or 50 to 200, depending on the size of the business and the raise, and then we follow on with those second raises after that. If you could move through, please. As I mentioned, we've got 2 funds operating in Australia. The first one we launched in 2018. The second fund, which is actually the ESV CLP, which is where the tax structures are for investors, for limited partners, that launched in Q2 in 2019. Obviously had a couple of challenging years with COVID as far as raising funds, but we've got 25 investments across both funds, and the ESV CLP has 14 investments in it, which I'll show you later. Our gross IR is over 40% in both funds, which we feel is very good, and we've got a really starting to build a good, strong track record in this very early pre-seed stage in the market. If you could move it, please, Hong. So just a snapshot of our performance and where our investments are concentrated. So as I mentioned, net IRR just under 50%. This is for our ESV CLP fund, which is operating here, and the gross is just under 70%. We've got a really nice diversity. It's all fintech. We're exclusively a fintech fund. We've got very strong capital markets credentials across the team. All of us have had sort of 25, 30-year plus careers each in various parts of capital markets. We really get the whole value chain, and as a result, spend a lot of time deploying our networks and our skills to help our startups grow. So we're in for the long haul. We're quite agnostic about board seats or not. It's really about what do the founders want, what the company needs, and what we can offer at that point in time. But we do everything from ad hoc advisory structures for founders as a touch point for them, if they've got boards they've already built and looking to move forward, right through to taking seats on boards. I for instance, chair one of the boards in our portfolio and sit on another one. It's a really great way to underpin our reasons for investing. So you've heard a little bit about this already here, but really we're looking at, what is the technology, obviously, although that's not necessarily the primary thing, because good tech can be enhanced fairly quickly these days if you can get the skills, that's of course, and the resources. The problem that's being solved is important. Also, does that problem want to be solved? Because often you can have a very good problem to solve, but there's too much inertia in the space to get traction to solve it. And actually the number one thing we look at is the team. We really are investing in the team. We spend a lot of time with teams, and we spend a lot of time talking about how they're going to grow and evolve as a team. So for us, putting that ESG lens on things right at an early stage isn't very common. We feel diversity does matter in all its guises at an early stage, and while it's hard to put in a formal way as you go through Investco, it's a very big discussion point for us, because we see the benefits and have reaped those benefits of having diverse teams at an early stage and having the founder or founding groups focus on that. If we go to the next one, please, Hong. So this is just a snapshot of our ESV CLP portfolio. We've got a couple here who are on to third raises right now. T-Shirt Ventures was formerly Provider Choice, that's an NDIS play, currently doing very well. Hutley also a prop tech business. We're quite diversified. We've got some very, very strong capital markets plays there with Boulevard around smart contracts, digital blockchain-based share registry service, but with a view to be able to provide exchange of value for unlisted securities, which is something I think even as a fund we'd be interested in. I'm just going to spend a minute, if I've got it, please, if you could move on, please, Hong, on what we want to see. I know there's probably only a couple of really pure pre-seed startups here on this call, but what we look for when we're raising funds, I think everyone's going to get these slides afterwards. So if we could move to the next one for time, please, Hong. This is my final slide. These are the pitch deck components we want to see here, really well thought through. So if you can focus on these and probably in this order, and really know your numbers, know your detail. As I said before, we invest pre-seed, pre-revenue. We really are looking at good teams who know their stuff, subject matter experts, have the right lens around how they're going to grow. It's a very competitive market out there, and also we've got some challenges now, some of it geopolitical, some of it elsewhere. So we do see a lot of companies. We can see 5 or more a week quite easily, even in just our fintech channel. So you do need to stand out, and it's really important to be robust on your pitch. I'll leave it there because I know we've got a Q&A. Thanks very much for listening.
Thank you very much, Cathy, and I hope all is well in Kiama. Sorry you couldn't be here with us today.
That's right, Deb. Thanks for not calling me old.
No, that's reserved for Symon. Yeah. That's reserved for Symon. So Alison's just going to check the chat for me to see if there's any questions. So for those of you online, this is your golden opportunity. But the other thing I would say is that we will, when you registered for this event, you opted in to be contacted, because I think somebody said along the way that sometimes VCs like to contact you rather than the other way around. And if that's the case, we will be certainly, if you opted in, we'll be sending the details, your details to them directly so that you can stay in touch. And the other thing that I've observed in having been around private capital markets for a very long time now is it's really important not to just come and go according to your capital raising cycles. You need to have relationships with investors that endure. And going on to some of the things that I picked up on is, you know, this very tight relationship that they have with founders and CEOs and things like that. And you will often see the same people popping up all the time. So relationships really do matter in private markets. And so don't be flaky and just come in when you're looking for money. And also, I think there was some great insights around that this is not just about bringing you in capital. It's actually the access to the expertise and experience that those organisations can bring you alongside the money to help you get to the growth. Now, we do have a question, and it's a question for Symon from Evelyn Moore, and Evelyn comes from Green to View, who are an ESG software platform. How does Advent measure ESG performance of your potential and existing investments? And if I could ask you to answer that in the microphone, that'd be awesome.
Yes, thank you. It's a topic close to my heart, so happy to speak through it. We identify number of KPIs for the individual portfolio companies that are relevant to their journey, either from an ESG perspective or a governance or a broader ESG perspective. So there are bespoke KPIs for each portfolio company. And then overall at the fund level, we have KPIs, and then at the firm level, we also have our own KPIs as well. So everything from customer NPS, which is ensuring that you're having very strong relationships with your customers, BNPS, which is ensuring you have great employee and a great employee working environment, and then risk-based sort of targets for tech businesses. That would be cyber, privacy information, and a lot. But trying to link it to something tangible and relevant to the value creation plan for the business, which either enhances upside, which is for customers and employees, and manages downside, which is something outside of risk.
Okay, that's really good. And presumably a lot of this has been driven out of your underlying investors as well, because they're demanding you to report to them on your, yeah.
Yes, yeah. It's in the last 2 years, it's just only accelerated. We were already on that journey. It's more about codifying things that we've already done. So for a lot of our businesses, improving governance was a very strong starting point for us. But we've now moved that along to the things I just talked about. Yeah. And more recently, carbon accounting through VC-backed business called Parts of the Road.
Thanks very much for that question, Evelyn. Is there anything else? Nothing on the line. Is there any questions from anybody in the room? I realise that you will all get a unique opportunity to have some juice and sandwiches. Sorry to the people on the line, we weren't able to give you juice and sandwiches, but hopefully you're having your own wherever you are. Any other questions from the room before we draw to a close on the online audience? Yes.
So it's around the significance around this. So ESG is super relevant. Particularly Symon's comment, it's really important to the whole industry. So all the investors, ensuring that those outcomes, so having a clear clarity and able to some measure those outcomes, people don't get identified as a potential quality company, but also is crucially important when you're visiting because ultimately it's all these kinds of questions and that due diligence and industry working together to try and come up with some fairly standardised frameworks to encapsulate what sort of advanced technologies are doing in that space to make sure that this is elected multiple questions from investors around that thing. So hopefully time will have.
Yeah, that's fantastic, and I think ESG is a really important thing for RegTech going forward, because if you think about it, RegTech are actually some of the solutions to the problems around ESG. So we're in a unique position in that the companies need to look at their own commitment to ESG, but then this is now giving them an opportunity to have a different style of conversation with their institutional customer base. So with the banks and others, to actually have a conversation less around software sales and more about a series of enabling technologies to help people achieve their ESG goals. So it's a different style of conversation than potentially they have been having. So it is going to be really, really important to RegTech from a number of perspectives going forward. And then obviously we've just heard that it's going to be really important to investors, and if it's one of the things that the superannuation industry has done really well, and that's drive some of that stuff, probably more than a decade ago now, when I was first involved in ESG at Avcal all those years ago. Dragan is just going to say something else.
So it's not just these investors, it's customers, right?
Yeah.
Just said ratings and skills of customers are demanding this, and so ultimately it's a convergence of everyone's expectations of fair convergence on all of this and with expecting it different as well.
Yeah, absolutely. Thanks, Robyn.
If I can just add to that too, just on a different tack, I think what we're seeing in the market too is that the types of companies that we're seeing emerge are climate related, ESG related, and it's actually the investments that are almost driving a change. So watch this space. I think there's going to be a lot more of that.
Yeah, thanks very much. Well, we might draw it to close for the online audience because I don't think we have any more questions there. Thank you for bearing with us in our very first slightly untidy hybrid event, but thank you very much for the team who've been working under a few trying circumstances to deliver this to you today. Go on our website. There's lots of fantastic new events that we've got coming up, and there are almost too many to mention. Oh, there we go. There's the slide. 9th of June networking here at Stone and Chalk in Sydney, and other centres to be announced soon. 27th of October is going to be a big one for us. We're going to all come together as a big community and do a gala dinner, have a flash dinner. We've been holding a credit for the last 2 years with an expensive venue. And finally, we're going to be able to have some nice wine and celebrate. And you can see lots of other things on this slide. So finally, thank you very much for joining us today. We'll sign off to the online audience. Thank you very much, Cathy, for joining us once again. And we will see you all again very soon. Thanks very much.